Hello and welcome to Lecture 6. We'll be discussing money markets. This comes from Chapter 6 of your book. Our objectives for this chapter are to describe the features of the most popular money market securities. We'll explain how money markets are used by institutional investors. We'll explain the valuation and risk of money market securities, and we'll explain how money markets have become globally integrated. So first off, money market securities are debt securities. There is a lender and a borrower. They're debt securities with the maturity of 1 year or less. So if it's longer than 1 year, it could not be considered a money market. If it's less than 1 year, it can be considered money market securities. They're issued in the primary market. That means they are sold out on the market. And this is done through a telecommunications network by the Treasury, corporations, and financial intermediaries that wish to obtain short-term financing. Okay, so they're sold, issued on the primary market. They can be sold, it says here on the last point, in the secondary market and are typically liquid, meaning they can be sold fairly easily. So they're initially issued on the primary market. After they've been issued, then they can be resold on the secondary market. And they're commonly purchased by households, corporations, and governments that have funds available for a short time period. For instance, I have a 401k plan, or at the university, a 401a plan. One of the investment options, if I wanted to keep something in something close to cash, very short term, there is a money market fund that is one of the investment alternatives available in the retirement plan. So households, corporations, and governments all have needs, and some of those needs are for a short time period. And if that's the case, they will invest in money market securities. Okay, so this is Exhibit 6.1 from your book, and this is how money markets facilitate the flow of funds. Okay, so we're going to start here on the left. Households, corporations, and government agencies that have short-term funds available. So they've got excess cash just sitting there, but it's short-term. They can't invest long-term. So what do they do with short-term money? Well, they've got a few different options here. They could use those monies to buy T-bills. These are treasury bills. And of course, these treasury bills are less than a year. So they'll give the money to the treasury, and then the treasury will use those monies to spend on government programs. Or they can lend the money to corporations by buying money market securities. And we'll talk about the different types of money market securities. And corporations will spend these funds to support existing business operations or expansions. And again, these are typically short-term needs because they're short-term investments. Also, they could buy money market securities through financial intermediaries. These financial intermediaries can give them short-term loans to corporations or short-term loans to households. Maybe something like a credit card or payday loan. These are short-term. So for households, they can spend on cars, homes, credit cards. Those are the funds. So this is the flow of funds when we're looking at money markets. So some of the more popular money market securities are treasury bills, T-bills. That's probably the most widely traded money market security. Commercial paper, which we'll talk about here in a little bit. Negotiable certificates of deposit, repurchase agreements, federal funds, and bankers' acceptances. So we'll go through each of these and discuss them in greater detail. First, treasury bills. So these are issued when the US government needs to borrow funds. Treasury issues T-bills with 4-week, 13-week, and 26-week maturities on a weekly basis. So they're constantly issuing new T-bills, and they will have maturities ranging from 4 to 26 weeks. The par value, or the amount received by investors at maturity of a T-bill, was historically a minimum of 10,000, but now it is 1,000 and multiples of 1,000. So there are different par values, but typically we'll look at those with 1,000, at least in the class. They're sold at a discount from the par value, and the gain is the difference between par value and the price paid. So it doesn't pay interest. All you do is you buy it at a discount. So let's say the T-bill was $1,000 face value T-bill. You're going to buy it for something less than $1,000, but at the maturity date, when it matures, the federal government will pay back, the Treasury will pay you back the full 1,000. So maybe you paid $850 for it, but you'll get 1,000 back, which means you made $150. We'll talk about how to calculate the gain or the yield here in just a little bit. They are backed by the federal government and are virtually free from credit or default risk. It's considered to be one of, if not the most safest investment in the world. So we do see when investors get spooked, sometimes they'll sell out of risky investments and buy treasury bills and treasury bonds. They're highly liquid. As we mentioned before, they're issued on a weekly basis. So they're constantly new ones coming on the market. People are buying them and selling them. They're highly liquid due to short maturity and strong secondary market. So investors in treasury bills are depository institutions, and depository institutions retain a portion of their funds in assets that can be easily liquidated to accommodate withdrawals. So banks, other depository institutions, they need to have funds ready and available to allow easy withdrawal, and so they need to be able to easily liquidate them. And so in the meantime, while they're holding this, they don't want it just to sit in cash because they're not earning any interest. So this gives them an opportunity to earn some interest. Other financial institutions invest in T-bills in case cash outflows exceed cash inflows. Also, individuals with substantial savings invest directly through money market funds. I mentioned that in my 401k plan. There is a money market fund available. Corporations invest in T-bills to cover anticipated expenses. So what is the credit risk? It's backed by the federal government. So as I mentioned in the previous slide, there's it's virtually free of credit or default risk. Also, liquidity is high liquidity due to short maturity and strong secondary market. Okay, so pricing treasury bills. They're priced at a discount from their par value. I mentioned that before. The price depends on the investor's required rate of return. If you've taken Finance 3250, this will be not a new concept, but we'll look at that a little bit more in this lecture. So the actual price is really what are investors requiring for their rate of return, and that'll affect what the price is. The value of a T-bill is the present value of the par value. So we're going to go through this example, which will show you how we could price a T-bill based on a required rate of return. So if investors require a 4% annualized return, we could say the market is requiring 4% rate of return. Market is made up of investors. So if they're requiring a 4% annualized return on a 1-year T-bill with a $10,000 par value, so at the end of 1 year, the investor will receive $10,000. The price that they're willing to pay is, so P equal price equals the par value divided by 1 plus 0.04. So let me write this out. Okay. So we've got the par value divided by 1 plus, we're calling this K. So K is what we call the required rate of return. So if we take this 10,000 divided by 1.04, the price is $9,615.38. And so this is clearly a discount to the par value. So an investor would pay this much, and a year later, they would receive the $10,000. Okay, moving onward. So how do we estimate the yield of a treasury bill? So here's the formula, and we'll walk through this. Um, so we've got yield, the yield of the treasury bill is equal to SP minus PP over PP. So SP is the selling price. As I mentioned before, there is a very strong secondary market. So people might buy a 1-year treasury bill, hold it for 3 months, and then sell it. So whatever they sell it for 3 months down the road is their selling price. So the selling price minus the purchase price divided by the purchase price times 365 divided by n. Okay, so the closer we get to maturity, remember you're buying this at a discount, and when it matures, let's keep with our $10,000 example. If we buy it for $9,600, as we get closer to maturity, the selling price will get closer to $10,000. So the selling price is almost always higher than the purchase price because it's a discounted bond and will grow in value as it gets closer. N is the number of days of the investment holding period. That's the holding period, okay? So that is how we will estimate the yield for treasury bills. I recommend you look in chapter 6 of your book, and you can see some example calculations on how they do that. So this is estimating the yield. We can also estimate what we call the treasury bill discount. So how discounted is it? And the formula is very, very similar. As a matter of fact, it's almost exactly the same. If your selling price was at maturity, then it would be $10,000, which is the par value. So the yield for the treasury bill or the treasury bill discount is the par value, that's the $10,000, minus the purchase price, which was the 96.15, divided by 96.15, times by 360 over n. As you'll notice, there's a little difference here. Here we use a calendar of 365 days, and this one is 360 days. That's not uncommon. You'll see in different financial calculations, depending on what is the norm, you'll either see 365 or 360. And I think that was originally done for ease of calculation. Okay, so how are they sold? They're sold at auction. Investors can submit bids online for newly issued T-bills at the Treasury's website. Investors have the option of bidding competitively or non-competitively. That concludes what we're going to discuss about T-bills. Now we're going to get into commercial paper. So these are short-term debt instruments issued by well-known credit-worthy firms, typically unsecured. So credit-worthy firm, if you were in 3250, Finance 3250, we talked about credit ratings. We've got a AAA credit rating or a AA credit rating, down to triple B, even down to triple C. So this is the highest credit rating, AAA, and it gets lower and lower. So the companies are less and less creditworthy. So short-term debt instruments issued by well-known creditworthy firms are called commercial paper. They're typically unsecured, meaning there's nothing backing them. So if the company defaults, the lender, the borrower, sorry, the investor who buys the commercial paper is the lender, they would be out. There's nothing securing that commercial paper. Where if it was secured, that means maybe the company pledged some form of property that if they didn't pay back the commercial paper, the investor could take the property. So they're normally issued to provide liquidity or to finance a firm's investment in inventory and accounts receivable. So it's very short term. Company has a cash crunch where they need some cash to either buy some inventory or other things. and that would allow them to have that short-term money. So the minimum denomination of commercial paper is $100,000. So it's not tiny amounts. So it's really for the large, well-known firms. Maturities are normally between 20 and 45 days, but can be as short as 1 day or as long as 270 days. The minimum denomination of commercial paper is usually 100,000. It can be more than that, but not less than that. I already mentioned the maturities. Credit risk, however, they're issued by corporations, and corporations are susceptible to failure. Therefore, there is credit risk in commercial paper. Risk is affected by the issuer's financial condition and cash flows. So the worse the condition, or the worse the cash flows, the more risk is faced on whether or not the investor will get paid back by the corporation who is selling the commercial paper. So these ratings, as I mentioned before, the AAA, the BBB ratings, they're assigned by rating agencies such as Moody's Investors Service, Standard & Poor's Corporation, and Fitch Investor Service. So those are the three top ones. It serves as an indicator of the potential risk of default. So a higher credit ratings suggest lower expectancy of credit default. And if we look at Exhibit 6.2 in your book, you can see here, this is for commercial paper. These are the commercial paper ratings. For Moody's, P1 is the highest. That means it's got the least likelihood of default, all the way down to NP, which means it's not like that it is likely to default. Standard & Poor's is A1 is the highest, and Fitch is F1. So P1, A1, and F1 mean very similar things. Each of these companies has rated the commercial paper for the issuing firms and looked at what is the likelihood that they won't pay it back. And so for the safest short-term commercial paper investment, you'd want to lend to these firms, the highest rated firms. So firms will place commercial paper directly with investors, or they can rely on commercial paper dealers to sell their commercial paper. Sometimes some of the commercial paper can be backed by assets of the issuer and offer lower yield than unsecured commercial paper. So if it's backed by assets, it's less risk, so they're going to pay a lower yield. That means the investor is going to earn less because there's less risk when compared to unsecured commercial paper. Issuers of commercial paper will typically maintain backup lines of credit. And so maybe they've negotiated with a bank to have a line of credit that they could call upon in order to pay back the people they borrowed the money from when they sold the commercial paper. So in estimating the yield for commercial paper also does not pay interest, very similar to the Treasury bill, the T-bill. So it's priced at a discount from par value. The yield on commercial paper is higher than the yield on a T-bill with the same maturity because credit risk is higher and there's less liquidity for commercial paper. Remember, T-bills are being issued every week. There's a constant market. It's very liquid. The US government is the least likely institution to default. If they run into trouble, they can just print more money and pay you back, or they can increase taxes and pay you back. And so there's a lot less credit risk with T-bills than with commercial paper. And that's why if you want a little bit higher yield, take on a little bit more risk and you can invest in commercial paper. So as we discussed yield curve and interest rates, there's a commercial paper yield curve. This represents the yield offered on commercial paper at various maturities. So what's the yield curve 1 day, at 20 days, at 40 days? What is the current yield? And you'll see a yield curve. If it's normal, it's going to be upward sloping. If it's inverted, which I don't know that we typically see much inverted yield curves for commercial paper because it's so short, but it could be flat or inverted. Okay, so the same factors that affect the treasury yield curve affect the commercial paper yield curve, but they are applied to very short time horizons. Commercial paper rate over time will change. It's highly correlated with the T-bill rate with the same maturity. So here, Exhibit 6.3 shows the T-bill rate since 2001. You can see it, for the short-term commercial paper, we were at about 5.5%, dropped through the dot-com bust, then we saw it come back up, but then we hit the credit crisis, and credit crisis caused a collapse in yields, and so you can see that the yields are hovering close to zero, although we've seen a little uptick through the end of the period on this slide. Okay, moving on to our next form of money market security. These are called negotiable certificates of deposits, CDs. These are often issued by large commercial banks and other depository institutions as short-term sources of funds. So you can go to your bank and you can purchase a CD. Well, these are negotiable CDs with banks. The minimum denomination is 100,000. So if you go to your bank, you might be able to, as an individual person, buy a CD. It's not negotiable, and typically they're less than $100,000, although you can find some that are higher. But these negotiable CDs are bigger, and the maturities on NCDs, negotiable CDs, normally range from 2 weeks to 1 year. Whereas you can get CDs for you personally that are longer than 1 year. A secondary market for NCDs does exist, which provides investors with some liquidity. So how are they placed? Some issuers place their NCDs directly, so with the investor. Others will use a correspondent institution that specializes in placing NCDs. In other words, some other company, institution that this is their specialty. They sell NCDs for the sponsoring firms. So how is the yield calculated? Well, you'll see this formula is a little different than the ones we've seen before. We've got a new term here, interest. That's because negotiable CDs will typically pay interest. So the yield on a negotiable CD is the selling price minus the purchase price plus interest all over the purchase price. Okay, so not only do we see some price appreciation, hopefully, but we'll also receive interest over the life of the NCD. So it offers a premium above the T-bill yield in order to compensate for less liquidity and safety. So it's going to yield higher than T-bill. All of these investments will yield higher than T-bills because they've got more risk, more liquidity risk, and more default risk. Next, we have repurchase agreements. With a repurchase agreement, we call these repos, one party sells a security to another with an agreement to repurchase the security at a specific date and price. So a reverse repo is the purchase of securities by one party with an agreement to sell them. A repurchase agreement or repo represents a loan backed by the securities, and that makes sense. So the company that's trying to raise some short-term cash, they'll have some securities that they could sell, but they want them back. They want to have them as an investment, and so they will enter into a repurchase agreement where they'll sell it. They'll have the cash for the time they need it. In the meantime, they'll be able to get back that cash and buy back the stock or the security. Financial institutions often participate in repos, and the size of the repo market is huge. It's 4.5 trillion. Transactions transaction amounts are usually for 10 million or more. So these are larger transactions. The most common maturities are from 1 day to 15 days and for 1, 3, and 6 months. Okay, so how are they placed? They're negotiated through a telecommunications network. Dealers and repo brokers act as financial intermediaries to create repos for firms with deficient or excess funds, receiving a commission for their services. So the dealers and repo brokers are doing it so they can earn a commission. And so they've got cash that they are buying these securities, and then they sell them back to the people they bought it from. So what was the impact of the credit crisis on the repo market? Many financial institutions that relied on this market for funding were not able to obtain funds. Investors became more concerned about the securities that were posted as collateral. Remember, the people who need cash have a security. Maybe it's a stock. Well, in a crisis, people might be worried about the value of that stock going down. So that collateral against more or less a loan may not be worth what they've lent out. So how do we estimate the yield? This looks very, very familiar, doesn't it? This is the way we estimated a yield in previous slide. This is for the repo rate though. So we've got the selling price minus the purchase price divided by the purchase price times 360 over n, the number of days. Next, we're going to discuss federal funds. We could call this Fed funds. Federal funds enable depository institutions to lend or borrow short-term funds from each other at the federal funds rate. So when one bank needs to borrow from another, they will lend or borrow at what is called the federal funds rate. Now this is not a rate that the Federal Reserve can set because it's set by market forces, but the Federal Reserve can adjust the amount of funds in depository institutions in order to influence the federal funds rate. So they can buy back treasury bonds or sell treasury bonds, which will either put cash into the market, into these institutions, or take cash out of these institutions. As you know, banks require a reserve. They have a reserve requirement. And what happens if at the end of the day, the bank is just under their reserve requirement? Well, they have to go borrow the difference from another bank. And one other bank may have more than their reserve requirement. So rather than just having it sit there earning no interest, they can do an overnight loan to another bank, another depository institution, and they will lend at what we call the Fed funds rate. The rate is normally slightly higher than the T-bill rate at any given time. Commercial banks are the most active participants, and that's because of the requirements that they have, the reserve requirements. The volume of interbank loans on commercial bank balance sheets over time is an indication of the importance of lending between depository institutions. In other words, we see, I think the book states somewhere around $360 billion of loans at any given time. This is at night, overnight. These are overnight loans. It's a significant percentage. And so you can see how important it is to the lending institutions. Next is something we call bankers' acceptances. And we're going to look at Exhibit 6.5 in your book, which has the diagram of how this is done. So let's make it through this slide. On the next slide, we're going to look at how the money passes. So it indicates that a bank accepts responsibility for a future payment. They're commonly used for international trade transactions. And so a bank will accept responsibility to make a payment on behalf of their customer. So exporters, those who are selling goods to another country, can hold a banker's acceptance until the date at which payment is to be made. But they frequently will sell the acceptance before then at a discount to obtain cash immediately. So they can hold on to this banker's acceptance up till the date that the payment is supposed to be received, and then that bank who has that responsibility to pay will pay the exporter the money. Well, what the exporter can do, rather than wait for the bank to pay, they can just sell it, and they'll sell it at a discount to obtain that cash immediately. They'd rather use the cash now rather than wait to get paid. Because acceptances are often discounted and sold by the exporting firm prior to maturity, there's an active secondary market for bankers' acceptances. So here we go. It says 6.4, I think it might be 6.5, but you can see here, step one, an importer decides they want to purchase something from an exporter. So they send in an order. They say, we want 500 widgets, okay? At that point, the importer, working with an American bank, the importer's bank will have a letter of credit or fill out an application for a letter of credit. That letter of credit is communicated to the exporter's bank. In this example, that's in Japan. So now the exporter's bank knows that the importer is good for it because these banks trust each other, okay? So the Japanese bank will give an indication, a notification to the exporter that there is a letter of credit, meaning that the importer is good for it. This American bank has vouched for them. And so at that point, the exporter will ship the goods. So the goods are received, the importer's happy, and they've paid for it through the American bank. Okay, so at the point of shipment, the exporter will then provide shipping documents and a time draft to the Japanese bank, which will then communicate it to the American bank, who will then provide those funds. So you can see it's a little complicated, but the trust between these banks is what made initial international trade possible. And so these bankers' acceptances and letters of credit from banks were very, very important to the creation of international trade. Okay, so here is a table that shows a summary of commonly issued money market securities. We've talked about T-bills, NCDs, commercial paper, bankers' acceptances, Fed funds, and repurchase agreements. So you can see who they're issued by, common investors, common maturities, and how active is their secondary market. You can see for T-bills, very active secondary market, bankers' acceptances, very active secondary market, moderate for NCDs, and low market activity for commercial paper. There's no secondary market for Fed funds loans because those are just bank-to-bank loans overnight. And then repurchase agreements. There's not a secondary market for those either. Okay. What about institutional use of money markets? Financial institutions will purchase money market securities in order to earn a return while maintaining adequate liquidity. So they've got a pile of cash. They don't want to have it just sit there and earn no interest. So they'll invest in very short-term money market securities to earn something. In the current interest rate environment, money market securities are yielding very, very little, but it can add up. Money market securities can be used to enhance liquidity in two ways. So newly issued securities will generate cash. If a company needs to generate cash, they can issue commercial paper, and they'll be able to generate the cash by selling that commercial paper. Purchased money market securities will generate cash upon liquidation. So if I'm an investor, and I've got extra cash sitting around, I want to have it earning interest, purchase a money market security, it'll generate the cash or give me back the cash upon liquidation. Financial institutions that purchase money market securities are acting as creditors to the initial issuers of the securities. And that's true if individuals were to purchase a money market security. So here is the table showing institutional use of money market securities. You can see commercial banks and saving institutions, finance companies, money market mutual funds, I mentioned that for the 401k, insurance companies, and pension funds. So this shows how they participate in the money markets. I encourage you to read these on your own. Okay, so how do we price out money market securities? So the price of a money market security is P sub M. So the price equals the par value divided by 1 plus K. Remember we talked about K. K is the required rate of return for investors to the N. So this is time to maturity. So if it's 1 year, we can put a 1 there. And par is the par value or principal amount to be provided at maturity. So a change in price can be modeled as this. Prices do not remain the same. The par value remains the same, right? If it's a $10,000 commercial paper, or sorry, $100,000 commercial paper, at the end of the time frame there, it'll mature, and whoever holds the commercial paper will receive $100,000. So that doesn't change. The time for the commercial paper doesn't change. The only thing that can change is K. So this is the required rate of return by investors. So this will change the price. So a change in price is a function of a change in K. And a change of K is a function of a change in the risk-free interest rate and the risk premium. So this is the rate that people could lend or borrow at if it had no risk. So a T-bill actually is a proxy for the risk-free interest rate. The risk premium, this would have to do with how risky the company is. How likely is the company to be able to pay back the money they've borrowed when they sold the commercial paper? And this risk premium could change. What if the company was AAA rated, but something happened? They had a major issue in a foreign country, or being sued for antitrust. A number of things could happen. Well, maybe they would be downgraded from AAA to AA, and that would affect the risk premium. And so we can see that a change in price is a factor of changes in the risk-free interest rate and the risk premium, which feed through to K, the required rate of return by investors. Okay, so here's a framework for pricing money market securities. This goes along with the previous slide. You can see we've got the risk-free rate here and the risk premium here. Well, what affects the risk-free rate? International economic conditions do. US fiscal policy, how much money is the government spending? US monetary policy, what is the Fed doing? And US economic conditions. All of those feed through to give us our short-term risk-free interest rate. For the risk premium, an issuer's industry conditions can affect that. Right now, we're dealing with the COVID-19 crisis. Airlines have been significantly affected, so the risk premium there has got to be a much higher. Also, issuers' unique conditions. So what are the company's specific conditions? Maybe the industry's doing just fine, but maybe this company has gotten itself into trouble. That will also affect the risk premium to the issuer. So these two affect the required return on money market securities, which in turn affect the price of the money market security. So this is K, and K feeds into the price of the money market. So How does the value of money market securities get impacted with changes in credit risk? And we've got an example from the recent past with the credit crisis. Credit risk following Lehman's default. And Lehman Brothers actually went bankrupt. They defaulted on money markets. They could not pay. It was a major issue. Institutional investors were less willing to invest in commercial paper as a result because they'd been burned. They had concerns that other firms might default as well. As a result, many firms were no longer able to rely on the commercial paper market for short-term funding. So if investors were not willing to buy commercial paper, then the companies needing to sell commercial paper could no longer find their short-term funding. The Emergency Economic Stabilization Act of 2008 was enacted, which helped to stabilize the money markets. And in November 2008, the Fed began to purchase commercial paper issued by highly rated firms to increase liquidity in the commercial paper market. So the Federal Reserve, government institution, went out and started buying commercial paper issued by companies to make sure that there was liquidity and a market for it. What happened to risk premiums following Lehman's default? Well, during periods of heightened uncertainty, investors shift from risky money market securities to treasuries in what we call a flight to quality. You'll hear this in the news. In a flight to quality today, more investors purchase treasury securities, something like that. And so that would create downward pressure on yields and would affect the risk premiums associated with commercial paper. So here is the value of commercial paper outstanding over time in billions of dollars. So you can see commercial paper ticking along, it was way up until the credit crisis. We've seen it drop steadily and level off here as of late. What about interest rate risk? So if short-term interest rates increase, the required rate of return on money market securities will increase, and the prices of money market securities will decrease. Now you remember, so the price equals the par over 1 plus k to the n. Okay, so let's look at this. It says the required rate of return on money market securities will increase. So if short-term interest rates increase, then K will increase. What happens to K? What happens to the price if our denominator here increases because K has gone up? Well, the price will go down. So as K goes up, if K goes up, the price goes down. And it's sort of like a teeter-totter. You can look at it this way. So if this goes up, this is going to go down. So money market securities are inversely affected. The money market security prices, I should say, are inversely affected to changes in interest rates. If interest rates go up, the prices of the money markets go down. An increase in interest rates is not as harmful, though, to money market securities as it is to longer-term bonds. And that's why you'll see when investors expect an increase in interest rates, they'll start to move to shorter-term debt securities like money markets because they know that their investment will be less affected by changes in interest rates. Participants in the money markets can use sensitivity analysis to determine how the value of money market securities may change in response to a change in interest rates. So they can calculate this. What if interest rates go up? How will that affect the value of my money market? Here is an illustration of that. We've got a rate, required rate of return, the interest rate at 3%, and then going up to 3.5, and then finally up to 3.8. And we're saying that there's an equal probability that these rates will occur. So we're not sure which one we're going to end up with in the future as an investor. If the rate is at 3%, then the value of our security is at 97,000 or 97 million. However, if the rate increases to 3.5, the value will drop to 96 million, 96.6. If the rate goes up to 3.8, the value will drop to 9.6. So you can see that inverse relationship there again. What about globalization? Well, as international trade and financing have grown, money markets have developed in Europe, Asia, and South America. So the flow of funds between countries has increased as a result of tax differences amongst countries, speculation on exchange rate movements, and a reduction in government barriers that were previously imposed by foreign investment in securities. Looking at Exhibit 6.10, we've got the international money market rates over time for the different countries. We've got the United Kingdom, the Eurozone, Canada, Japan, and the US. So the US is red. It's kind of been in the middle of the pack over this time. Japan has, over the last couple of decades, really experienced very, very low rates. And you can see United Kingdom was at the highest at the beginning of this chart, but is now right in there with everybody else. So they've kind of come together. You can see a lot of differences over these periods, but as rates have dropped and as we've seen what's happened over the last 10 years, rates have become very, very similar across nations. So we will use the term Eurodollar to describe dollar deposits in Europe. So Eurodollar securities, there are Eurodollar CDs, certificates of deposits. These are large dollar-denominated deposits, such as $1 million, that are accepted by banks in Europe. So that would be a Eurodollar CD. It's sold in Europe, deposited US dollars. Euro notes are short-term securities issued in bearer form with common maturities of 1, 3, and 6 months. So bearer form means that you actually have to hold the piece of paper. Euro commercial paper is issued without the backing of a banking syndicate. Maturities can be tailored to satisfy investors. Again, you'd want to look at the company's creditworthiness before you purchased any commercial paper. There's also an international interbank market amongst banks. So this facilitates the transfer of funds from banks with excess funds to those with deficient funds, sort of like the Fed funds. And LIBOR, which stands for London Interbank, so this is this interbank. There was a LIBOR scandal in 2012. Some banks were found to have falsely reported their rates that they periodically report in the interbank market. And it was a big scandal, and currently there's action being taken to replace LIBOR. So how do we look at the performance of foreign money market securities? Well, we're going to look for what we call the effective yield, which is a yield that has been adjusted for the exchange rate between currencies. So where we start off, step one, we're going to figure out what is the yield in the foreign currency. So we're going to calculate just the same way we have with the other things. We're going to take the selling price in the foreign currency minus the purchase price in the foreign currency divided by the purchase price of the foreign currency. Okay, so once we have this y sub f right here, we're going to plug it into this formula to get the effective yield. So here we've got 1 plus y sub f times 1 plus this term has to do with the exchange rate from the US or from the foreign currency into US dollars. And so this will affect the overall yield for somebody in the US. This is the foreign yield, and then we take into account the exchange rate and end up with the yield. So this is the way we would calculate it. So just to summarize on the next couple of slides, the main money market securities are T-bills, commercial paper, negotiable CDs, certificates of deposits, repurchase agreements, federal funds, and bankers' acceptances. And these securities vary according to the issuer. So their perceived degree of credit risk can vary depending on that issuer. They also have different degrees of liquidity. Therefore, the quoted yields at any given point in time vary among money market securities. So the more risk in general, the higher yield for the money market security. Financial institutions manage their liquidity by participating in money markets. They may issue money market securities when they experience cash shortages and need a boost to liquidity. They can also sell holdings of money market securities to obtain cash. Last slide. Last 2 points in the summary. The value of a money market security represents the present value of the future cash flows generated by that security. And we looked at the formulas on how to do that, very simple formulas. Most of them are very similar. So since money market securities represent debt, their expected cash flows are typically known. It's usually by indenture or contract. However, the pricing of money market securities changes in response to the shift in K, the required rate of return by investors. The required rate of return changes in response to interest rate movements or to shifts in the security's credit risk. Finally, interest rates vary among countries, although we've seen them become very similar in recent years. Some investors are attracted to high interest rates in foreign countries, which cause funds to flow to those countries. So if the US rate is 3%, but we can see another country, it's at 6%, that will be attractive to investors. Consequently, money markets have become globally integrated. Investments in foreign money market securities are subject to exchange rate risk, though, because the foreign currency denominating the securities could depreciate over time. And so when we are investing in money markets overseas, we not only have interest rate risk and credit risk, but we also have exchange rate risk to add to that. With that, if you have any questions, please reach out to me. I'm available during my office hours, or you can shoot me an email and we can figure out a time to chat. Thank you very much.